So one of the biggest misunderstandings is whether or not there's a death tax. Um, in the United States, there is an estate tax, there is gift tax, and there is generation skipping transfer tax. There is an exemption amount that's shared by all three. And in 2023, that exemption amount per individual is $12.92 million. So if you have an estate that's less than $12.92 million, then you don't have any estate tax that's due. The estate tax is reconciled with gifts made during your lifetime, generation skipping tax transfers that were made during your lifetime, and there's various tax returns that are done for those to account for them. Now, most Americans don't have the problem of an estate tax, but some do. The estate tax exemption amount that's shared by all three of those things is changing at the end of 2025. The law sunsets, and it's going to adjust to a new amount that's estimated to be around $6 million per person. So at this point, for a married couple, we're going from almost $26 million of exemption down to closer to 12. So that's a huge change that's coming up. So there's a lot of people that are planning for that, but like I said, most people don't have that problem. The death tax that most Americans have to deal with is the tax that's due on inherited retirement accounts. They're usually qualified accounts like traditional IRAs, 401ks, and that type of retirement account where the person making the money takes the amount and puts it into a deferred plan that gets to grow tax-free until they retire, and then they pay taxes on it as they pull it out. And it's great for growing wealth and saving for retirement, but the problem is when you pass away and you leave those accounts to people, they then have to pay taxes on it. And that is treated as ordinary income for the person that inherits it. So if you are in one tax bracket and you're maxed out at, let's say, 22%, and you receive $100,000 in an inherited IRA, it's going to push you $100,000 up into the next tax bracket and increase taxes that are due. And that's if you take it all in 1 year. We used to be able to do some planning to stretch that out over time, but when the Secure Act was passed in 2019, the government changed those rules. So you have to take it out in over a 10-year period. Now, that doesn't apply to certain qualified people, such as surviving spouses, minor children, and certain disabled people. There are a couple other very specific exemptions, but generally speaking, you have to take it out over 10 years, and it goes to whoever's inheriting its ordinary income. So they're potentially paying, on the high side, 37% federal income tax on that money because it pushes all of their other income up into that bracket. It's important to note that we have a graduated scale for income tax in the United States, and it doesn't mean that all of your money becomes taxed at whatever the new rate is. It's graduated, it steps up. But most Americans don't realize that that's the tax that has to be paid. There are certain planning techniques that can be used to offset that. I've seen trends where people have used irrevocable life insurance trusts to help save money to pay those taxes. But it's just about being strategic. Working with a financial advisor can help figure out what's the best way to minimize the effect on your tax brackets, taking it out over time, or taking more out 1 year versus another. It doesn't have to be equal parts over those 10 years, but there needs to be a lot of planning going along with it. And that's why it's really important for your financial advisor and your attorney to work together. It's something that a lot of Americans deal with because most Americans' wealth is tied up in their retirement accounts. So I hope this gives you some insight as to planning. If you have questions about this, reach out to your state trusts and tax attorney.